Okay, let's begin. So welcome again, everyone. Thank you for attending our webinar. I see that some of you have already attended other webinars are here today too. So welcome back. Today's webinar is quite special because we have a special guest with us. Our special guest is Anne-Claire Maurice. Anne-Claire is our managing director for all of Kaiko's quantitative analytics solutions, and she's gonna discuss today her solution called implied volatility and how this can be used. But also she's going to discuss with our research analyst Adam on how implied volatility can unveil things relative to past events that happened as the massive sell-off that happened this summer or other major crypto market events. In addition to that, we'll have Desi speaking later in the webinar on major market events that happened this quarter. And to begin, I'm going to present you Kaiko very briefly now, but also give you some latest news about some publications that the research team has made recently. For those that are new here and are not familiar with Kaiko, Kaiko is a digital assets data provider. We've been around for 10 years now, and we provide the industry with market data, including volume, order book, prices, and more, as well as on-chain data and quantitative analytics and indices. In addition to this data, we provide freely accessible research. So you can find our research on our research website, research.kaiko.com, and every week you can follow our research by subscribing to our weekly newsletter called the Data Debrief, but also to our deep dives, which are also a newsletter, but which provide you with some investigations on specific topics, as more recently on implied volatility and ETF's impact on the markets. In addition to these research products, which you can find archives on our website, we also publish reports, and specifically our quarterly crypto market report. We have published the Q3 crypto market report very recently, so this week, which you can find on our website too. Can you go to the next slide? I've put here a QR code that you can scan and download directly this report. This quarter, we talked about all major crypto market events, including general performance of Bitcoin and other assets, how major central banks' policy changes have impacted crypto markets and in general risky assets markets, and finally altcoins and ETH ETFs, specifically the performance of the ETH ETF that has been launched this summer. And finally, the latest research report that we have published is the IV report. Next slide, please. Perfect. So through this report, we explain what is implied volatility and why does it matter, how it's been calculated, tailored on crypto for crypto assets. And finally, we also contextualize IV for recent market events and explain to you which types of visualizations can be produced in order to extract most of the value from our implied volatility tools. Now I'm going to give the stage to Adam and Anne-Claire, who are going to proceed with the core of the webinar, which will be discussing this implied volatility tool, but also giving you examples of how it can be used, for what, etc., etc.
Thanks, Anastasia. Yeah, and just for anyone who might be new, I know most of you each month, but I'm a research analyst at Kaiko. I mainly cover kind of deep dives and help out with debrief. I write a little bit about derivatives, Bitcoin ETFs, and everything that Anastasia has already mentioned. This is going to be a little bit different this week. We're going to try a little bit more of a conversation. So if you're if you're kind of a returning viewer, you might notice that. So, as always, any feedback on that would be great. But yeah, just want to introduce you to someone we all know in Kaiko, but you might be first time seeing Claire, who's, as Anastasia said, the MD of Quantitative Analytics. So yeah, I'll kind of pass over to you, Claire, if you want to introduce yourself and tell us a little bit more about your background pre-Kaiko, what you do at Kaiko as well.
Sure. Thank you, Adam. And thank you, Anastasia, Lucy, and Adam for having me. It's always a pleasure. So yeah, sure. So I joined Kaiko 2 years and a half ago, almost 3 years now. But prior to Kaiko, basically I started my career as an IT quant on traditional finance. So I started at BNP Paribas. As an IT front office on a desk of complex and structured products, mostly equities, but also some mutual fund rates and commodities. Then I joined, in fact, École Polytechnique, where I was on a mission when I was a research engineer working with two mathematicians on optimal times to optimize gamma hedging of equity derivatives portfolio. So all of a program here, but it was very interesting, and it led to the creation of basically a quant boutique named Quantitative in 2018 to commercialize this algorithm and this product. We had a partnership with the London market maker EDJ and Société Générale, and we started to work on crypto and on the gamma of in cryptocurrency with Kaiko in 2021, in fact, and then it led to the acquisition by Kaiko of Quantitative in 2022 to leverage on all the data that we have at Kaiko, because it was our legacy business to collect and normalize data. And we wanted to leverage on all this data to create a quantitative business unit, to develop a large suite of tools to help our clients operate on the crypto market. And so it goes from risk metrics to derivatives analytics as implied volatility or pricing services. And really our role today is really to provide the market with quantitative tools that are adapted to cryptocurrencies to approach the market with the same level of rigor that we have in TradFi.
Nice. And you said there that kind of what you guys want to develop is tools that can help assess risk in the market with similar rigor to TradFi. I mean, what makes crypto different? What makes it more difficult compared to traditional finance and your background pre-Kaiko? What are the main challenges there in doing that?
Yeah, yes, definitely the maturity of the market is the main challenge, I would say, when it comes to both spot markets and derivatives markets. Of course, when you talk about risk analysis, first, there is a spot market, but very often, even in TradFi, you use the derivatives market to assess the risk that you take on the spot market, but also to hedge and do lots of stuff like that. So, but the problem is that in the crypto ecosystem, the derivatives market is not as mature as we can see in TradFi. Sometimes TradFi is even more liquid. On the crypto market, it's not the case. So as for both spot and derivatives, we have lots of different venues with lots of different players playing on the crypto markets. So the liquidity is kind of spread out everywhere. And when it comes to spot versus derivatives, sometimes you cannot even trade the underlying spots of your derivatives on the same venue or anywhere, in fact. So it leads to inaccuracy in terms of risk assessments and risk management in general. So lots of different venues means also, it doesn't mean inefficiency, but in this case, there are inefficiencies. Definitely markets are inefficient. They are arbitrageable in practice. So it's also a kind of it's a problem, and for at least for some players. Then there is also a real, and when it comes to derivatives, it's really the main challenge, at least to me, is that there is no standards in the market on the instruments. When it comes to the underlying product, the expiries, the settlement, the collateral, all the specifications of the instruments, the options, the futures, the calendar futures, even the perps, they are not the same from one exchange to another. Some new exchanges tend to reuse some specifications from the older ones, but still there is no standards. So it means that the instruments are not fungible. There is no interoperability between venues, which in general doesn't help the market, because it's more difficult for institutional players to come and to operate on this market, because usually they don't trade only on one venue, they trade on several, but then they have to manage some other risk because of this non-standardization challenge. And yeah, all of this, I think, makes the risk assessment very noisy, and it's very difficult for players to extract insightful information from the crypto market.
So that final point you're talking about there is that sort of the markets aren't asynchronous, that there's a lot of like different futures and options contracts, or different expiries, different structures to them, and this makes it more difficult if you're just kind of assessing the market. That's kind of what you mean, is it?
Yes, exactly. In fact, if derivatives trades on the expiry hour, if the expiry time is at 8 a.m. in the UTC, and on OKEX it's at midnight. So when you consider medium-term, long-term options, then the impact and the difference, the price difference between the two options with the same other characteristics other than expiry time, the price is very similar. But when you talk about short-term options, then it's not negligible at all. And when it comes to model things and model risk, then it has a huge impact.
Cool. So yeah, so I guess the amount of different venues, fragmented liquidity, and sort of the lack of standardization makes all let's noisy, as you kind of laid out there. But specific now to Kaiko and your team, how do we solve for this solution? Like, let's say with our implied volatility tool that we've recently been kind of doing a report on and relaunching, how do we specifically handle those kind of issues?
Yeah, so when it comes to IV, there are even more challenges. If you for options specifically, then if we can talk about again about specifications, first there is a huge issue with the tick size. In fact, if you look at the tick size, it's 10 to 20 times higher than in TradFi markets. So with the liquidity, sometimes there are if sometimes the bid is only on one tick or two ticks, so it makes the IV computation very, very noisy. So we have to deal with large beta spreads, missing bids for out of the money options, with a few trades sometimes on some expiry. Definitely the matrix of price of strike and expiries is really scattered in terms of trades and prices. So when you need to calibrate a full surface to have something that is really two-dimensional, three with the implied volatility, but in terms of input parameter, you have an incomplete matrix. And so it's another challenge when it comes to implied volatility. And first of all, you need to compute an interest rate. And we all know that there is no consensus when it comes to interest rates and the risk-free rates in the market. So these are the challenges that we face when it comes to implied volatility, and that leads to inaccuracy in prices and uncertainty. So the way we deal with that at Kaiko is, in fact, it relies on 4 steps. First, we have a cleansing of the data with stringent rules to detect, to filter out outliers in prices, to filter out prices that we that are not to us, that doesn't contain all as much information as we think, in fact, and to really discard the data that we are not comfortable with using it in our calculations. Second, as I said, we have to compute interest rates in a robust way. So we have two methods to compute interest rates. We basically can compute interest rate based on the future market, but also based on the put call risk parity. It was important for us to have both in the past because the first methodology, the first methods using the future market used to be the more accurate one, but we saw that when there are market events, very often the futures market on crypto is more liquid, and in fact it's more reactive to market events. So on very big market events, you can see asynchronous markets and asynchronous reaction between futures and options. So it can lead to an interest rate computing using the futures data that you cannot use in the option market because of this asynchronicity. So yes, we do monitor that, and it's very important to do that. Then the third step is that we apply what we call the data augmentation step to enrich the data set of prices that we have, and also to unbias the estimator when there are large spreads. And finally, we just apply, after the calibration, when we have the SVI parameters, we apply that detection outlier step to discard any erroneous parameters, especially in the wings, because we know that even with all the steps that I mentioned, it can still happen in the end.
Nice. That makes that was very thorough. I actually realized I should probably put up I made a little chart using our IV data, which is probably a bit more interesting than just the title for people to look at. But yeah, you said something really interesting the other day when you were talking about implied volatility, and I thought it was I wanted to kind of dive a little bit deeper into it. We've touched on it now, but you said that when it comes to developing sort of an IV tool like this, a robust solution, it's not about competing with external providers, but more about the internal calculations. So I was wondering if you could you expand on that a bit for us as well?
Yes, that's true, I think. And the main reason is that the traders on the crypto market are usually traders coming from TradFi, in fact, at least for institutional players. So it means that they are used to other model, like FX model, equity model. So usually crypto are traded like FX. So risk models for FX are well known, and the traders are very familiar with them. So intuitively, they will use FX model to crypto, and that's what has been done in the past. And there are two things, in fact. So as long as the market wasn't significant in terms of volumes, in terms of investment amounts, it was okay to do that, because if it's just 5% of a portfolio, then, or 1% of a portfolio, it can be okay in a large institution to not be as accurate on your risk assessment on crypto than you are on other with other asset class. But it's still very challenging because of what I said earlier, liquidity and the noise, etc. But anyway, you can do that. But it's not the case anymore. At least for BTC and ETH options, they are more and more liquid, and you have now to take into account the idiosyncrasy of crypto. In fact, so I do feel that yes, until now it was okay to use a in-house model, a very well-known model, to price crypto options, to compute IV, but that it's less the case anymore. And even if one can argue that for now BTC and ETH are more liquid, so there are less challenges to price them, at least the options, but it's still not the case for all the altcoins. Some have just a few expiries, 3, 4, so to compute a full surface, it's not a lot. And some have just a few trades per day. So again, it's not a lot. And even for BTC and ETH, we saw when markets are very shaky, I would say, we saw that it's still important to have all the safeguards in place that I've mentioned in terms of outlier detection, interest rates monitoring, because, as I said, we've seen some asynchronicity and some other, when the markets are shaky, even for BTC and ETH, we've seen that it's not enough to just to calibrate the surface. You have to put extra things in place. So even if people do feel that they can compute it themselves, I said yes, most of the time they can. I agree with that, but still you need clean data, you need data from lots of different venues, and also I do feel that ignoring all the points and the challenges that I mentioned earlier and applying just standard model is missing a part of the problem. And because you can't be sure about the analysis, about the indicators, it won't be as stable, as robust. And finally, you don't have the guarantee that it reflects the market reality, and that you capture the right information.
Nice, that makes a lot of sense. And I guess no one better than us to provide all that kind of robust data on the broader market. So, but with that in mind, maybe for this, I'm getting a lot of good questions in, so I think everyone might know more than me about this. But for anyone that doesn't, with IV, what are the kind of like top use cases that we've identified that we kind of target?
So for now, most of our clients use our IV product for one, that it's used by exchanges to publish mark price and to open option desk. Or 2, it can be used by market maker or prime broker to establish their risk margining model. So basically.
So I was on mute. And for those people using it, I noticed like someone else on our team, Keith, had a good point that most of these services most of IV services can be arbitrageable or don't adapt to the idiosyncrasies of the crypto markets, something you've kind of alluded to already earlier. But can you talk us through that a little bit more detail, specifically with regard to the surface and what sets ours apart?
Yes, for sure. So about the specificities, I've already mentioned some, but about the arbitrageability, so we have 2 main things to deal with that. First, we do have penalty constraints in our calibration. So in our algorithm, we do take into account, we have penalty constraints for both butterfly and calendar arbitrage. So what it means is that it's not a guarantee that the surface won't be arbitrageable in the end. Because if the data set is very noisy or very arbitrageable, then it still reflects the market. So we do want to publish this surface. But if there are just some points that are arbitrageable, we don't want that to pollute our calibration. That's why we have these penalties. And in practice, so as I said, it can happen, but most of the time, I would say 99% of the time, our surfaces are not arbitrageable. And the second thing is that So we do have that for the calibration of the smiles, and for the interpolation part, we have a method that ensures that if the smiles are not arbitrageable, then the interpolation, of course, won't be arbitrageable, and it's preserved.
Great. No, that makes a lot of sense, and I think that concludes this section on going through the IV specifically. So we're going to pass over to Desi in a second for a little bit more discussion and look forward a bit. But just wanted to address just a couple of questions in the chat, and please keep those coming. We're going to get to them in five or so minutes when we're done now. But just going to hand over to Desi, who's going to talk about what to expect in Q4 and how the market is positioning ahead of the elections and some more central bank decisions.
Thanks, Adam. Yes, so in continuation of what you and Anne-Claire discussed, I'm going to talk a bit about some of the main risk events lined up for November. And so before diving into the charts, this is an infographic with some of the key elections we had in 2024 and some of the events for November. We know that 2024 is actually a record election year with half of the world's population going to vote. Arguably, the most important one is coming in early November. It's the US elections, where crypto has taken a very central stage, with one of the candidates being a bit more or perceived as Bitcoin positive. But we also have general elections in Japan just before, and we just wrote a piece on how macro and political uncertainty is impacting local crypto markets and risk-taking. In between, we have some very important macro data on US labor markets, which is going to drive the Fed decision on November 7 between 25 and 50 basis points. So how is the market positioning for all these risk events? Looking at the implied at the money volatility, as Adam and Anne-Claire just explained, implied volatility is a way for the market to understand how the market perceives risk for different expiries. Here we have the November 8th expiry, 29th of November, and 27th of December. Typically, shorter-term expiries have lower volatility because there is less uncertainty around the price of the asset. We see that for November 8th, the market is clearly expecting some turbulence, and the term structure is slightly inverted. Now, briefly looking at trade volumes and moving to the next chart. Most of this volume, again, for the November 8th expiry, is actually concentrated around 70K. This is a 10% increase relative to the current price. And this is mostly calls, so bullish bets. I don't have the chart here, but for Ethereum, we have seen some increase in trade volumes recently, which is very interesting because it kind of suggests that the market is seeing Ethereum as a proxy trade for ahead of the election. And it can benefit as well, not only Bitcoin, but also Ethereum from improved regulatory certainty. On a final note, before we go to questions, we are going to publish next week a more in-depth analysis of how elections are impacting the market. We know that the political risk is very hard to price in, so looking forward to that.
Thanks, Desi. And I think with that kind of concluded, we're going to jump over to the questions. So if you have any more, please drop them in the chat. But if not, I'm going to go to one from which is earlier on, I think, when we were discussing outliers in the data, and it's not sure if you can see it in the chat, Claire, but it's given the high vol observed intraday, don't outliers filtered out provide important information?
Of course, we don't want to. In fact, it's always a challenge when it comes to building quantitative products. Is that you want to filter out the noise, but without discard any information. It's always a trade-off. That's why it's tough. So yes, we've tested our methodology on lots of different scenarios and use cases to ensure that we don't do that. And what we saw, in fact, if we go back to real-time data in the past, historical data that we have, we can see that we are still very reactive to the market. Adam, if you can go back, maybe, I don't know if you have the slides with the surface, the evolution, the dynamics of the surface during Yes, this one. So this is daily data, but still, if you look at the surface, so we have one update every minute, and if you look at the surface every minute, you will see that we don't miss any information. And if there is a market move, then we will capture it. But we don't want to capture spikes that are just either not temporaries, but that are just noise. And or when you also we are taking both trades and order books data, because there are not enough trades, and sometimes for order books you have an order that is just late and they're in the order book for a couple of minutes and that is outdated. So that kind of data you want to filter out.
Nice.
I hope it answers the questions.
Great. Thanks, Anne-Claire. I think the next one is for you as well. It's on, do the options used to compute the IV have enough open interest? So I think, does that come back to fragmented markets again? And
yes, no, definitely there are not enough trades. That's what we are adding the order books prices and data to the trades. But in fact, we see that the order book is pretty dynamic. So the market depth is there. So for in some venues, no, there are not enough open interest. But if you add the liquidity, then you still have insightful information.
great. I think the last question for now is on OTC markets and OTC options markets. Do we have any insights on these?
So for now, we don't cover any OTC option markets. It doesn't mean that our methodology won't work on these markets, but we don't have this data yet at Kaiko.
Awesome. Well, I think that's all the questions for now. I guess thanks so much for joining us this week. Anne-Claire is really, really, really helpful, and it's been fun working on this as well with you and the team over the last few weeks. I don't know if there's anything else to add from us. Just as Desi pointed out, we've got the kind of a deeper dive in the elections and the positioning ahead of that coming up in the next couple of weeks. As always, we've got our weekly debrief next Monday and every week after. So thanks so much for coming, and see you all again soon.
Thank you so much.